Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Bailey Lipschultz joining us. Obviously, the meme stocks, this was all the rage. But Gamestop today, so they came out with earnings kind of unexpectedly. They also were in the market issuing shares. I feel like it took them a minute to get it together, no?
It did, and that's really been the thing. We've been writing about it this week. We wrote, I believe on Wednesday, basically saying the window to capitalize was narrowing, if not closing, because GameStop, their quarter ended a few weeks ago, so they needed preliminary results before they could file to potentially sell shares. They did all of that this morning, but Alex, as you point out, the stock was trading north of $50 on Tuesday. Before they even got a chance to sell, it crashed back below 28. So now we're seeing selling pressure down 27%. 55 million shares have traded so far. Again, an ATM allows them and allows their bank to sell up to 45 million shares. Not necessarily a sign that they have, but reading between the lines would mean that they probably are.
Do we have any better idea here who any of these 55 million share people are? Like, who's trading this stuff? Again, is it going to go back to your thoughts about that? The quant hedge funds that are kind of really generating the activity? Yeah,
and we're still not seeing really the volume that we saw on Fidelity, on Interactive Brokers, on some of the retail platforms that we did see back in 2021.
And that's data you guys can see, the public can see?
You can see it if you have an account. Yeah. Okay. So like I had to create it. Fidelity, it used to not be behind the paywall. They put it behind the paywall. But like if you have an account, you can see what on a given day people are buying and selling. It's just the orders, but it's mixed.
You expense that?
I do not. Well, it's a personal account.
Oh, I thought you just did it for the reporting.
No. I do now expense a premium X account though. That was a recent addition. So
nice, good.
Small wins.
Redo won't mind.
The small wins matter. Do we know why it didn't last longer? Is this just basically weren't as many shorts out there? Is that why the meme stock rally was a hot minute?
It's a really different backdrop. So not only do you not have people stuck at home looking for entertainment, flush with stimulus checks. Short interest is about 25%. It used to be north of 100 back in the peak mania. A lot of, again, the buying and selling that we saw Monday and Tuesday seemed to have Wall Street's fingerprints. So it never really got retail traders back in like back in 2021. And also you had a quiet Monday and Tuesday session ahead of the inflation data on Wednesday. And then you add in the fact that investors, retail traders probably bought in and were sitting on big paper losses. So you provide an exit ramp for them. Why would they not take advantage of it?
Did Bill Gross make money on this with his straddle?
He still is. Those expire today. I haven't talked to him since he laid out the initial trade, so he might have closed it or tapered it down. But that straddle still is very much in play and in the money, assuming shares don't.
So he bought calls and puts at $40, right?
He sold. You logged in, so now I'm off the terminal.
Wait, you were using my login?
I sat down where you were
sending messages to people under my name.
There's a certain person, a morning anchor, that leaves his Twitter account open.
He does.
Oh, I find that helpful.
Yes.
Actually. I know what all those people are talking about.
I want to go to another area here. We were just talking about Reddit and how that was such a great IPO, and they had some good news today, popping the stock up again here. We have a number of really good IPOs performing over the last couple of months. I got David Solomon up on stages saying the backlog's building. Where are all my IPOs? I need to see 5 or 6 a week.
The backlog has been building for 3 years at this point. Every banker you talk to is like, the backlog's been better than it's ever been. Yeah,
I want to see days when we have 4 printing, like on a Thursday.
Yeah, well, don't hold your breath.
So what are we waiting for here at this point?
Well, the real thought is drawing back investors. So you have Reddit performing well. You have Astera Labs, Viking bougie cruises, for lack of a better frame, all performing well. But you have to get deals that are priced well, to Paul's point, make the investors money, make the sponsors happy, and perform well. And that's really still kind of weaning back into the system. There is still uncertainty around how much of a slowdown will we have in the summer just because bankers and investors are on vacation. We do have an election in November. It seems like we will have a more active than usual June, July than historically speaking. But the big focus still is on that post-Labor Day window, which will be kind of compressed because you want to get out before the election, but also when people are actually at their desks and you can go visit T. Rowe and Fidelity and have a real pitch.
There were days back in the day when Morgan Stanley, Goldman Sachs, us at Credit Suisse or Salm, we'd have to get on the phone and say, all right, guys, we're all going to be in New York on Thursday. We got to coordinate this. All right, you do your lunch at the Four Seasons 11. I'll do mine at the Intercontinental 12. You do yours. That's how busy it was, and because you get those windows. And I feel like
I haven't.
This could be a window.
And when I talk to investors and bankers, the big argument that they make is the window has always been open for good companies.
Right.
It's just that good companies who have access to the private markets maybe don't want to go out just yet and be the first.
But
or
I also
second
hear,
out.
these PE guys whining how they've been sitting in these things for 5, 6, 7, 8, 10 years. They're looking for an exit. Well, okay, if you don't want to if you don't want to take the streets mark, then let's hit it. Let's go.
Well, that's the big issue.
I don't want a down round.
You have to call it a down round. You have to cave a little bit on valuation, especially because to your point, a lot of these PE assets are heavily straddled with debt.
Yeah.
And investors don't want debt right now. They want clean stories that can be sold to them. Viking was one that's interesting that has a large debt log, but it's viewed as kind of being recession-proof because it's wealthy people, older people taking cruises.
Interesting. You just did a flex there. He called it a flex.
I just pointed at myself before.
Wealthy people taking cruises. All right, Bailey, thanks a lot. Super appreciated. Happy weekend. Bailey Lipschultz joining us. IPO market as well as the meme stocks.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
It has been definitely a week. We had some nice records. We haven't seen this kind of move in months for the S&P. So what do you do? On a headline level, we may continue to be a little bit boring, but underneath there's some really individual stock moves that are gaining a lot of traction here. So let's get more with Shelby McFaddin, investment analyst at Motley Fool Asset Management. She is joining us. So, Shelby, are we in a world where the headline level is just going to continue to grind higher, but it's going to be those individual names where you get the action?
I think that's absolutely possible. And part of it is we've seen the evidence of that happening for not just 1 year, but 2 years, right? We've seen it go from the S&P 500 to sort of the S&P 7 to the S&P 4. And so it's not completely unreasonable to have to pop the hood and really see, breaking into sectors and industries, what's really going on in the market. And so if you're sort of just interested in owning the overall market and being okay with it being driven by fewer than 10 stocks, sure. But the inverse is not necessarily true, that how those top 10 are doing is necessarily representative of the overall market.
Shelby, we had a weaker than expected retail sales number yesterday, yet combined with some pretty strong sales numbers out of Walmart. How do you square those two things? How do you view the consumer out there?
I think when we sort of look at those two things, we see the fact that consumers are looking for value. And so when we do look at Walmart, we consider the fact that general merchandise for that retailer is still weaker than they would like to see. And a lot of the performance comes from the necessities like food and different staples. So when we see those weaker retail sales, we're realizing that discretionary income is still being pressured quite a bit. And that when people are looking to spend what discretionary income they have, they're looking to get value. So in the past, they may have been a little bit indifferent about saying, let's just go ahead and order the TV from this online retailer or pick it up from this standard big box retailer. Now they're considering, you know what? Let's check out Walmart. I think they actually have a lot of value that they can offer us.
For those of you who didn't hear yesterday's show, Paul is going to a Walmart for the first time in a long time. He's going to do some channel checks tomorrow, right?
Yep, on it.
It's going to be huge. So Walmart stock at a 52-week high today. Is this priced in, or is there more upside here, you think, to Walmart?
I think part of what we're also seeing in the sort of little Walmart run-up is the fact that they've made that decision, I think, within the last couple of weeks to close a lot of their health clinics. And they're also having some staff reduction, and they're cracking down on folks working remotely. So they're doing some of that OpEx as well. So what we're seeing now is the effect of the bottom line boost. So at first, Walmart was able to sort of hold on to their top line for a bit longer than others. I think what's being priced in now is the fact that they are leaning out in ways that they don't usually take on. They've traditionally just kind of cut their hourly workforce, but now they're really looking at the big picture of investment. And I think that's the sort of pop in the stock we saw yesterday.
So, Shelby, I guess one of the questions here is, the lower end consumer, how are they dealing with it? Where are they going with their dollars? Are they staying with Walmart, Target? Are they going down to the dollar stores? How is the lower end consumer, how are they spending their discretionary income?
I think what we've seen in a combination of between Walmart and other sort of not retailers, but manufacturers that have branded material is that consumers are choosing brands, even at the lower end, where there is the most premiumization that they require. But then they are choosing more of a Walmart over a Target at the lower end, because at this point, you can't really stop how much food you're going to need. You can try and make your clothing and other sort of discretionary items last a little bit longer, stretch them a bit longer, but food is just such a requirement. And so when we then combine that with what we saw from the financials companies, we're seeing that at the lower end, they are just using less credit, trying to get paid off what they can. And so if they're just working with cash, it's going to be, all right, let's get all the discretionary stuff that we have to get on top of the staples we need at a place like Walmart. And I'm not quite sure that we're seeing that absolute trade down into, say, food shopping at dollar stores quite yet. I don't think we're there just yet.
I don't know, man. Food shopping at dollar stores feels like you are asking for expired stuff. Anywho,
It's
That's
tough.
exactly
It's
what
tough.
happened to me.
Did
Buying
that happen to
bread, and the person at the checkout goes, "You don't want that, sir."
you're like, it's green. Why are
Yeah,
you buying
she's
something
like-
that's green? To that point. Shelby, there's tons of retail action next week, right? You get Macy's, Target, you do get the dollar stores, Ross stores, like you get the specialty guys. What's going to be a macro signal for you here?
To me, I think it's actually going to be these sort of the sort of middle to lower end, the Ross, the Burlington, the dollar stores, letting us know how much of a higher income customer share they're picking up. Because it's been very obvious that they were going to get more of the middle to lower end. That's the whole point of their retail premise, right? So the question now is, how much of the upper end consumer are you reining in? For Ross, are you capturing some of the consumer that was going to Marshalls or even Nordstrom Rack? Similar for Burlington. And then when we look at Target, are they able to capture or hold on to any middle income to lower income share? Because we do know that they have a little bit more of a premium product.
Just so we're clear here, in the Journal today, there was an article about TJ Maxx and why it's awesome.
Right.
Because they were like, anyone who's anyone can now go and buy like super high designers for like a third of the price. I love TJ Maxx. It's like in my blood. But I mean, it was in the Journal. I'm just saying,
happening.
like,
So
like,
now it's
already happening, but now, like, you know, real people with like serious money, like Real Housewives people are doing it. Just putting that out there. Yeah,
I didn't know that. Okay.
According from the Journal.
Very good. Well, if the Journal has it, I'm going with it. Hey, Shelby, in some of your stock picks here, one of them is Kenvue. Just a reminder, that was a spin out from Johnson & Johnson, I guess. Talk to us about Kenvue.
Yeah, what's interesting about Kenvue is they sort of followed in a trend that a lot of the pharmaceutical companies were doing, where they went ahead and separated their consumer brands. So we're talking about, you know, the Tylenols of the world into a completely separate company. And what interested me about that going into earnings season was whether or not they would be able to sort of maintain that demand on premiumization. When we think about the fact that if I need Tylenol, I could just buy acetaminophen and it's cheaper. And what they showed us in earnings is that they've been able to do it. So the brands that they've cultivated have held on to people to spend that extra $1 or $1.50 on baby wipes, on feminine products, on pain and other healthcare. So that was a great signal to us that to some degree, with the right mix of pricing, you're able to hold on to people for even brand name staples. And I think that is really important.
Your last pick here that you have on the notes here is MasterCard. Why do you like this stock versus some of the other guys?
Yeah, one of the things we love about MasterCard really in general is that they're really just a toll taker, right? So even in a sort of downturn, the rails still have to be used to process payment. The other thing is really their weight to credit compared to debit. So we do know that a while ago we had that legislation that really compressed on debit fees. So when we look at their competitor, we see that they've got that better mix to that sort of higher fee for using the credit rails, and also knowing that consumers leaning a little bit more on credit in these types of times, at least in the middle to upper end, generates more fees for MasterCard. So when we think about the credit to debit mix plus their international opportunities, we feel that they're really well positioned when it comes to the payment network space.
All right, Shelby, thank you so much for joining us. Shelby McFaddin, investment analyst at Motley Fool Asset Management, joining us from Alexandria, Virginia via Zoom. Let me show you how cutting edge I am on fintech.
Okay.
When I go buy my salad today for lunch, I'm going to use Apple Pay.
Hey, look at you.
Exactly.
What happens to the wad of cash in your pocket?
I still have the wad of cash. It lasts a lot longer. Like when I was growing up, even as a young adult, I would only use credit cards for big purchases, kind of special one-off type of things, not for day to day. I use cash for that. Now it's the exact. I think out there in society, it's just use it for everything.
I'm sorry.
Oh no,
Michael Barr.
Oh my God! First of all, he pulls out a wad of cash, a couple of $100 bills.
Absolutely.
You know, not the deed, the boardwalk like I have in mine. But wow, what happened to cash?
You know, the only reason I have cash, and John Tucker can back me up on this, you go down to the Jersey Shore, that's a cash economy down there. You walk up to a Jersey Shore bar, you don't Apple Pay, you throw a 50 or 100 on the bar, and that's how you announce your presence.
I also
there.
love that you said hundy because I say that at home. My husband refuses to talk to me. But to that point, but actually, tipping is the problem. Like if you don't have cash, I never carry cash anymore, and the tipping is huge. If you go get a mani-pedi, it's
boy.
like, oh God, do you guys have Venmo? And then you're like scrambling, and it's stressful.
It's a changing world out there in terms
first
of
world
you have to
problems.
be on top of this fintech. And a lot of people say, just buy MasterCard or Visa. That gets your exposure to fintech because it's all got to run over their systems.
And remember, take care of your bartenders, ladies and gentlemen.
Exactly right.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's get to tech. There's been some fun news. I was taking a look at this Reddit OpenAI thing. So apparently the deal between the two helps display Reddit's content and also train OpenAI's systems on its partners' data. So this kind of what they promised when they IPO'd, and then maybe a little extra. Mandeep Singh joins us now. He is a Bloomberg senior technology analyst. Mandeep, give me some of the particulars here.
Well, they haven't told us who is paying whom. It's just that I mean, look,
they're friends, man.
We know Google pays Reddit almost $60 million a year for its content. And in return, I think Reddit benefits more in the sense that, yes, they get paid and they also get traffic from Google, Google displaying Reddit's links on its search. But in this case, I think OpenAI probably needs Reddit data more simply because you have to constantly train these LLMs. I mean, Reddit has almost 1 billion posts a year. Look at the magnitude of the user-generated content. So yes, OpenAI has the most powerful LLM out there, but LLMs needs these large data sets. And that's where Reddit is one of the most coveted data sets on the open internet. If you think about it, Twitter being another one, there are other forums that generate a lot of user-generated content. But that's what you need to constantly train these large language models. And I thought Google's LLM had an advantage because, one, they were training on these Reddit data sets, which OpenAI didn't have license for. And also it establishes a trend that you have to pay for content now. It's not free anymore. So every content provider will start charging a licensing fee.
I'll jump on that train.
Yeah.
You know what's impressive about Mandeep? So many things. On a Friday, in studio.
I totally knew you were going to bring this up.
And, now, so he basically leads our BI effort in New York because the senior management is safely ensconced, leading from the rear in Princeton. So he's our guy here in the world's financial capital. But what I love about the Reddit story is, I love this Reddit management team. They get the gold star now. They went public saying they were going to do something.
And they did it.
And they did it, and the IPO shareholders are benefiting. That is such a class move, man. They want to come back and sell more stock, I'll buy it.
Yeah,
that was a nice move.
Raise, and look, I mean, compare them to a company like Pinterest. Same number of daily active users, same number of monthly active users. Pinterest trades at a 25 billion market cap. Reddit is still a $10 billion market cap. Yes, there is a revenue gap. I mean, obviously Pinterest generates 3.5 billion in revenue. Reddit's is much smaller. But in terms of engagement, user trends, everything looks similar. So
we'll get to Snowflake in a second, but I have one more silly question.
Yeah.
So when I'm going on Google and I'm searching something now, and then it gets me eventually to all the, here's what Reddit's saying and all those links, is that because of these kind of partnerships?
I mean, look, Reddit, again, has the most authentic user content, communities that people want to know. Like, they don't want canned LLM-generated answers. People want real answers where users are having an engagement and discussing a topic. And that's why Google is prioritizing Reddit's results in their 10 blue links. I mean, yes, they are adding like AI overviews and all that, but they are prioritizing Reddit in their first 10 links because they find these links to be more engaging for their users.
Okay, let me just give these guys a pat on the back here. Reddit went public September 17th, 2024 at $34 a share. The stock's at 63 and change here today, up 85%. That's a nice trade. That's a nice investment. They should be doing some more stock, and more companies should be coming public. I don't know why the floodgates aren't just gushing with IPOs. What is Snowflake, and what's their AI strategy?
Well, so Snowflake is a layer that's on top of your hyperscalers. You remember, hyperscalers gives you the compute, the database. So Snowflake is like, I will aggregate all your data into a nice dashboard. That was their value proposition. They were immensely successful until this whole generative AI and LLM wave popped up, which was very disruptive because one, Snowflake didn't have any of their large language models that all these companies, the hyperscalers, have. And then obviously abruptly their CEO resigned and they appointed a new CEO, and his playbook seems to be to develop an LLM, because otherwise they're at the risk of getting disintermediated. Look, it's still a high growth company, still mid 20% growth, hugely impressive. But for a while, they couldn't put a step wrong. They were growing 40% plus. And so suddenly that growth decelerated, and I think it was because of the not having an LLM. So that's what they're trying to solve for here.
So they're in talks to acquire Reka. Am I saying that right?
Yeah.
Reka AI for more than $1 billion. So that would solve their LLM problem?
I don't know if it's going to solve, because with LLMs, the clear leaders have been established. It's OpenAI, Google, Mistral, and Meta, the 4 or 5 players. All the smaller players are finding it's too expensive to constantly train their LLMs. So the consolidation is happening. And now, obviously, they are getting sold. But in this case, Snowflake bought them first. I'm sure Amazon is looking to buy somebody, and so are other companies. Apple probably is looking to buy someone as well, because that's what you need. You need your own LLM. You can't rely on someone else to provide the LLM if you're a large tech company.
How many large language model companies are there out there? Is my son starting up one, then he's going to get bought out for like $1 gajillion?
It's very hard to start an LLM company. One, because you need a lot of compute, the NVIDIA GPUs. You need a lot of data. Like Reddit is one data set. You need thousands of data sets to create your LLM foundational model. And then you have to constantly train these models. So this is an expensive proposition, and I feel that's why the hyperscalers are the ones who have the capex and the deep pockets to do this.
And okay, bear with me on this dumb question. And we care about this because why? Because then I can go on Google and then they tell me stuff?
Think of, co-pilots and AI agents, all these new concepts that are coming to the scene are enabled by LLMs, because LLMs have the IQ of an average human being. And then it can be, customized to do specific tasks according to, customer service or booking travel. But basically, behind the scenes, you've got a very intelligent algorithm that has a knowledge of, the world. And you can talk to it. You can converse in it. It's not canned answers. It's not a database that you're searching for. It's an intelligent person.
Okay, this is not like me asking, Alexa, what's the weather like? And she's not like, I don't understand your question. Like, it's not that.
No.
Got it.
It's much more sophisticated. Yeah.
All right. I mean, whatever. NVIDIA next week. Stock's up 90% this year. Is this another quarter where they have to knock it out of the ballpark?
I mean, the basic thing is, are they under-shipping demand still?
Are they under-shipping demand?
They don't have enough product.
Because everyone corroborates that we are supply constrained when it comes to NVIDIA GPUs. So they will keep writing this until the demand environment is such where demand exceeds supply. And I think they have a good shot of beating and raising again.
The options market is interesting. Isn't priced in the same kind of exuberance that we've seen in the past, which doesn't necessarily mean anything. It just means that maybe positioning is in a particular place going in, and we're not expecting that exuberant call buying. Mandeep, thank you so much. We appreciate you always. Mandeep Singh, Bloomberg Intelligence, Senior Technology Analyst.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence analysts. There are 400 of them worldwide. They cover 2,000 companies and 130 industries. We got you covered. We just talked about retail. We saw Walmart. We got Macy's, Target, some dollar stores also coming up. So we go nerdy because we can do that on Bloomberg Intelligence Radio, and we can talk to a forest and paper products analyst. It's a box analyst. Our box is shipping. Where's the demand? How's it going? Ryan Fox is a Bloomberg Intelligence market analyst for forest and paper products, and he joins us now. Ryan, we are super excited to talk to you about this. How's the box business?
Well, the box business is not seeing its best days. We had the worst first quarter in the last 8 years. Box shipments are down over the last 2 years, almost 10%. And maybe there's some silver lining because the second quarter, statistically speaking, over the last 30 years has more often than not been a better quarter than the first. So we do see maybe there's going to be an increase. On average, increase was 3.2%, like I said, over the last 30 years. However, given the backdrop that we're seeing in the broader economy, we think we're going to see a more muted increase, maybe more like 1% sequentially, which would still be a year-over-year decline of about 1%.
So, Ryan, I know you and other analysts and investors look at the year-on-year kind of growth rates, and that's kind of big. Just give us a sense of the absolute numbers. Like how many boxes, whatever units you use, are being used like today versus 2019? Yeah.
So in one of the best terms is in billions of square feet, right? So when you were to, if you were to take a box and unfold it and lay it out flat, you just do length and width and all that.
That's what I do when the boxes come. It's my job to break them down.
Of course, understood.
Well, yeah, you got to flatten them and then put them in your recycling bin.
Yeah, John Tucker doesn't do that. Just throws them in the recycling.
Well, so I try to think outside of the box.
Oh, no, Ryan.
All right, Ryan, let's get back to it. Just again, today's demand versus pre-pandemic.
Yeah, so in 2019, that volume was like 393 billion square feet, right? A big number. During the pandemic, it grew to 416 billion square feet. Last year, it fell to 380. And this year, our projections, our mid-year outlook says it's going to fall again to about 376. Again, a slight decline over last year. We're just not seeing super strong economic signals. And our box, so our box producers, Green Markets is a Bloomberg company. They go out and they survey box producers all across the U.S. and they have a good signal, right? The signal right now is that the second quarter could be up as much as 3.5%, which is in line with the statistics we've seen over time. However, again, first quarter was down substantially. So we think there's some optimism error, and we would guide down based on that known optimism error.
Ryan, this is a really dumb question, but I feel like the trend is don't ship stuff in a box. Like I can order from different places that shoes, I agree that they're in a shoe box, but you don't put them in like another box. You just ship that shoe box. Is that eating into this market at all?
It certainly is. And I could talk for an hour about this, but I won't. But yes, you're exactly right. There's a definite move by brands to reduce their waste and become more sustainable. So you are seeing companies like Amazon utilize paper bags and things like that.
So talk to us about the green options out there. What are the green options?
Well, it depends on what you mean by green, right? So
what do you mean by green?
So there are two main initiatives, right? So the first green initiative is to find something that's more circular in nature, like a paper bag, because most people identify paper as a more sustainable, more circular option. Now, if you're looking at the data, that paper may have a higher greenhouse gas emission index. So while it's more circular, it's going to have its trade-offs. If you're looking for chasing the greenhouse gas initiative, maybe you're going to a plastic, something that's lighter in weight. Very broadly speaking, greenhouse gas emissions follow weight. So if you're using a very lightweight paper or plastic bag, it will likely have a lower GHG emission, but it's less circular. So it really depends on the goal of the company.
Are people willing to pay more for greener packaging? Do we know that yet?
They say they are. They say they are, but no one really is. I mean, at the end of the day, I think it's just opinion, and it doesn't really mean anything.
So, what are the companies that you follow that if investors want to get exposure to this, where should they look?
Well, I mean, on the Bloomberg terminal, our packaging dashboard, PACKG is the call numbers there. We follow International Paper, WestRock, Packaging Corporation of America are the big three in the U.S. They represent about a $45 billion market cap.
What represents the best kind of value? Like, how are these guys sort of trading right now? What's priced in?
Great question. That's way above my scope. So I'm more of a market analyst and follow the bigger industry trends, supply, demand, and pricing. I don't really get into the stocks themselves or the companies themselves.
That's fair enough. Fair enough.
Can I make an inference about inflation out there by looking at volumes of packages being shipped and all that kind of stuff?
Absolutely.
What is it?
So how's that work? Yeah.
Well, so there's some discrepancy. So right now, if you were to look at like some of the federal data, real PCE for goods, for instance, that number is still very, very high relative to the fact that consumer goods are not trending very well. I mean, if a very high number, 90% plus of consumer goods ride in a corrugated box, and that volume is down 10% essentially over the last 2 years, how in the world is our goods spending still up? If it's a real number and it's adjusted for inflation, there's a disconnect there. And I have some speculation on why that is. I think, historically speaking, when you think of things like software, 30 years ago, software came, it was an actual thing. It was a disk. That may still be one of the items that's counted as a good, but it's no longer a good. It's a downloadable thing. It's a software as a service. It's a something else. And so there's probably some noise in there that's not allowing us to see some of this clearly.
That's really interesting. Thanks a lot, Ryan. This was great. We both really loved this segment. Ryan Fox, Bloomberg Intelligence analyst, covers paper packaging trends, sort of diving in to all of that.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I'm Alix alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We cover all the top news in economics and finance through a lens of our Bloomberg Intelligence analysts. They cover 2,000 companies, 130 industries worldwide, and there's about 400 of them, and a large chunk of them actually cover ESG. So let's rewind to about 4 years ago, middle of COVID. Everyone was talking about ESG. BlackRock was talking about allocating a bunch to ESG. This was where all the money was supposed to be flowing. A new report from Shaheen Contractor, she's Bloomberg Intelligence Senior ESG Strategist, says that liquidation of U.S. ESG ETFs reached almost 30% of all closings so far this year and could continue amid some slowing flows, particularly if the backlash we've now seen in the U.S. on ESG continues. Shaheen, great to see you. Thank you for joining in studio. So I guess let's take a step back for a second. In ESG, it's environmental, social, and governance, right? Where did that go so wrong? Like, how did we get from 2020 to here?
So Alex, just to paint a few numbers. In the first quarter, we saw about $4 billion in outflows. I mean, compare this to 2021, which is about, I want to say, close to $50 billion in inflows. Wow. Now, I wouldn't call it where we went wrong. I think what we're seeing today is slowing flows because, the market is maturing. But at the same time, these outflows that we're seeing, they're very concentrated to a few funds. So actually, I'll repurpose. Where we went wrong is that whole rise in assets was very concentrated to a few funds and a few investors. So it's very noticeable when that comes out, and that's what we're seeing.
So who are those investors or those investor types, and why are they pulling their money out?
So one example is ESGU. It's the iShares ESG Aware. It's probably the largest ESG ETF in the world. Last year, it saw about $9 billion in outflows, and we attribute this to model portfolio changes. So, that could be allocative or it could be due to ESG. For example, an investor doesn't want equity anymore. They just want cash. They just, sell out of equity. So whether it's ESG, whether it's not, to be honest, we don't know. A lot of these outflows are also from European investors. I wouldn't attribute that to the backlash.
Meaning that the backlash has been more in the U.S. versus, say, in Europe.
Correct.
Do we need to separate the E, the S, and the G? Separate the social from the governance from the environmental, or at least separate the environmental part?
I would say no. I mean, I know that's an argument, but I still think that ESG is about material risks and opportunities to a particular company. For some, it's E, for some, it's S. So it's going to be very hard to talk about this separately.
To what extent is the environment for flows in ESG in the U.S. versus Europe, or U.S. versus the rest of the world, how are they different?
Very different.
Okay.
So again, the U.S., 4 billion in outflows the first quarter. Total flows were about 6 billion in inflows. So the rest of it was almost entirely Europe. So Europe continues to sort of, we call it anchor.
Is that because of, it's like everything in this country, it's been politicized?
Yes.
Okay.
Well, the slowing inflows is the politics, but the outflows are this concentration. Sorry, Alix.
But I was going to say, but also, isn't it just that for a while, ESG tracked tech? Because just on a pure E level, and S&G, they just have less employees.
Sure.
They, until the data center situation came up, they were just emitting less carbon because they're not industrial companies. They're not cyclical companies in that way. Well, now what?
So, Alix, if you're asking, is this driven by performance because ESG tends to tilt a certain way, I would say I don't think so. I mean, 2022 was a bad year, yes, but last year ESG ETFs were about performing with the market, about 50% beat the market, which is average. But we still saw so many outflows. So it's that concentration from a few funds, not this, mass exodus because of a certain factor.
Okay.
Do we know where we are in that fund flow situation? The folks that have pulled it out, are we near or at or nowhere near the point of that being over? Do we know?
We don't know. I call it a bit of a pause. I mean, unless all this concentration risk unravels, I don't know when we're going to stop seeing outflows. At the same time, we're not really seeing inflows.
So I guess how many products are out there now? And how many products should there be? Rough estimates.
I would say globally, it's definitely north of 1,000. In the US, it's probably north of 500. Again, very roughly.
And these are ETFs primarily.
These are ETFs, sorry, only ETFs. And they span across multiple things, right? ESG, gender, climate, clean energy, all these different themes. How many should there be? I don't know. And I would say, Alix, that's a little bit of a reason for these liquidations. There was such an oversupply in 2020 and 2021 that these uncompetitive strategies are shutting down, and that's normal.
So if I'm Will Danoff, portfolio manager of Fidelity Contra Fund, who's done a great job for me, thank you, Will. Do those funds, to what extent are they factoring in ESG analysis into their investment criteria? Is it different today than it was 2 or 3 years ago?
It depends. I mean, I think a lot of the conversations are shifting a little bit. You have, dedicated ESG funds, climate is in the name, ESG is in the name, but then you have these broad ESG integrated funds. And those are always, considering risks and opportunities. What I think has changed is data availability. You have just a lot more data around climate change, around physical risks. So people are asking these more evolved questions around, things that I wouldn't have asked probably either a few years back.
I guess my question always is, until you can financially measure the benefit of a strategy that is focused on ESG, it's going to be very difficult to then make a case for an investor or a CEO of why these strategies matter. 100%. Have we been able to do that yet?
So my research is starting to answer that. So I'm starting to do industry level analysis into what impacts risk and returns. For example, in materials and governance, we find lower drawdowns, so lower risk. We're still to, explore that and expand that. But I will say within the E and S, it's particularly hard because of the limited data historically.
Right.
All right. Interesting.
Yeah. All right, Shaheen. Thanks a lot. Shaheen Contractor, Bloomberg Intelligence, Senior ESG Strategist. I think, at least from my work in energy transition space, there's no carbon price. So you can't do that on the environmental side. Because you can't say, look, you emit this, it costs this. There's nothing concrete that then a CEO can go to the board or go to shareholders and be like, look, guys, this is why I'm doing this. is a big problem. It's a big problem,
Yeah.
yes. And then how to do that. And you have to have everyone agree on it, or else you're doing a cap and trade situation, which is very confusing. You're just going to wind up importing something from, say, China or India, where it has higher emissions, and then why would you pay more for something that's internal? In country. I think that's definitely a big problem. And also, how do you measure success of, say, diversity and inclusion?
Yep.
Is it a straight up numbers on your board, but does that actually materially make a difference unless you're open to their ideas?
Yeah, well, I can talk. Well, in data, you can go to the FA screen for any
Here it
security, and there's an ESG tab. In addition to income statement, balance sheet, cash flow statement, there's a separate tab for ESG, and that's where Shaheen and a lot of other folks at Bloomberg's Global Data try to aggregate a lot of this data as well to help out our clients for ESG analysis.
I love that.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.